As investors game out what this new Trump administration will mean for the markets. Well, let's bring in our experts. Chris Toomey, top 10 private wealth manager with Morgan Stanley, and Cameron Dawson, chief investment officer of NewEdge Wealth, both here at Post. Nice to see you both.
Good to see you.
Thank you.
Cameron, you get the ball first here. So as we look towards 2025, okay, now we know who the Treasury Secretary is going to be. We think we know what the kind of policies are going to be and what he's going to champion along with the president. What's it going to mean for the market?
It's a question of what that translates to for earnings, meaning are these policies actually going to change the earnings tide where we see a lift to earnings estimates going into 25? If we don't, meaning that these policies may take more time to play through into the market, actually get enacted, then it's a question of how do we tolerate high valuation, stretched positioning, stretched sentiment going into 2025. So I think it's definitely a question mark of how much impact he can have in the short run as we round the year.
Yeah. How are you thinking about this as you advise your clients on what this new year is going to bring?
I mean, I think the base case is pretty in line with the rest of the street right now, expecting probably above average growth with regards to earnings. The economy continue to do well. We're expecting about 75 basis points worth of cuts in 2025. So it's probably a pretty normal environment from a return standpoint. Investment grade, treasuries, all the fixed income should do well. I think what's really interesting is what's going to happen in the tails, right? So we're in a situation right now where 2024 earnings came in a lot better than expected. GDP came in a lot better than expected. We're in a situation where we went from hard landing to soft landing. Now we're in a soft landing to no landing situation. You've got a new administration. We saw how powerful fiscal spending can be with regards to pushing the economy into the next level. We're really in a situation where you get animal spirits going, you get M&A picking up, you get IPO market picking up. You could be in a situation where maybe the Fed cuts in December, but come in 2025, you could be in a situation where the Fed has to be a little bit careful with regards to reducing rates. And you're in a situation where the U.S. is situated where they're holding higher and the rest of the world is taking rates lower. And so that could be a really interesting dynamic going into 2025. That's not necessarily your base case, but could be an interesting case within one of the tails.
Is it all right? Maybe the Fed should be taken off the front page. Because if you're going to stimulate higher growth, you're going to have lower taxes and lower deregulation. Lower regulation. Maybe you don't need to be so reliant on these rate cuts, which some suggest aren't even needed to the degree as the market once hoped and thought.
And to the point that it could actually be a risk if you deliver more rate cuts. If you're cutting rates as aggressively as what the dot plot currently has forecasted, it could be throwing lighter fluid on a fire, given how easy financial conditions are. You're at a point where these markets aren't begging for rate cuts because valuations are high, credit spreads are tight. Then the risk is if you don't get those cuts and everybody else is cutting, you could have that stronger dollar, which then creates these wild cards of what it means for U.S. stocks versus international stocks. So there's a lot of different ways that a Fed that's not as easy as expected could impact these markets.
Your bull case, Chris, is 7,400.
Exactly.
That tells you, how much, I guess, in your mind, maybe the goalposts have moved. For somebody who's been relatively cautious and more positive after a while, but now it feels like that's a goalpost changing call.
Yeah, I think that's my point with regards to the extremes, that higher extreme and that lower extreme are really starting to become more probable versus the base case. So you could have a situation where you get that M&A activity. To Cameron's point, you start getting in a flood of dollars coming into the U.S. You've got a lot of dollars sitting on the sidelines coming in and a lot of chasing into the market. That could lead to some euphoria that could really push these markets significantly higher. The flip side to that, higher for longer isn't great for everyone. And so as we get closer and closer to that maturity wall, you're going to really see a difference between key winners and key losers.
Sure, but maybe we're not going to be as higher for as long as we thought, right? Rates have come down. What we think we know about the kinds of policies that Mr. Bessent is going to pursue is a higher level of growth, and thus more growth is going to impact the deficit, which theoretically will take some of the edge off of rates. Is that right?
So
that's how it should work.
He might want to pursue those kinds of policies. I think it's a really good question as to how he can pursue those policies.
Why so? If they just re-up the tax cuts and they're going to cut regs, Doesn't one sort of feed off the next?
It certainly helps. And the question is that he did talk about wanting to extend the tax cuts. We might not get a further cut to corporate income taxes or corporate taxes, which just means that we stay at that level. We don't get that extra boost. The question is, do you see Treasury being able to impact energy policy to get 3 million more barrels a day? Treasury doesn't control spending. They don't control taxation or spending. They fund the deficit, but they don't control the deficit.
No, but we're already on the good side of, supply demand, at least what we're producing here. We've never produced more.
So the current projections of the deficit to GDP actually assume that the tax cuts don't get extended. So it's an incredible journey from the 6.9% where we are today to 3%. So it's a question over what time frame we actually get to 3%. And if you get a lot of government spending cuts, that actually would weigh on growth in the near term, simply because you're pulling back on government support for the economy.